Good afternoon to all dignitaries, delegates, and the guests. I, Dr. Kirti Arekar, Professor NISM, welcome you all for the second panel discussion of 4th SEBI NISM Research Conference 2023. The theme of the panel discussion is Growing with Sustainability, Inspiring Practices Relevant for Emerging Markets. It gives me great pleasure and an honor to introduce our esteemed panelist and the moderator for this panel. The first panelist is Ms. Sue Lloyd, is as a Vice Chair of the International Sustainability Standard Board. I welcome you, ma'am. The second panelist is Mr. Sacha Sadan, is the Director of ECG and at the FCA Financial Conduct Authority. I welcome you, sir. And the third panelist we have with us, MVR Reddy, who is currently holding the position of CSO cum Executive Director at NTPC Limited. I welcome you, sir, for the dais. Our next panelist, Mr. Navneet Munot, who is the MD and CEO of HDFC Asset Management Company Limited. So okay. And we have our moderator, Mr. Amarjeet Singh, who is working as Executive Director in charge of Market Regulation Department, responsible for policy formulation and supervision of Market Infrastructure Institute. I hand over the mic to moderator, Mr. Amarjeet Singh, to start with the panel discussion.
Yeah, thank you so much. Good morning to both of you there in Europe, and good afternoon to my colleagues sitting besides me on both sides. So, let me just set the context in terms of just some quick and very broad observations on the current ESG landscape. These are very, very quick, some sort of a broad takeaways. So I guess as all of you here in the room and otherwise would know, that the concept of ESG has very rapidly evolved in the recent years. So as I said, the concept has very rapidly evolved in recent years. What used to be a niche area a few years back is now increasingly becoming mainstream for businesses, investors, and society as a whole. Just to give you some data points, there's been a 5-fold increase in internet searches for ESG since 2019. More than 90% of S&P 500 companies now publish ESG reports in some form or the other. And I believe 70% of Russell 1000 companies also do the same. In a number of jurisdictions, reporting ESG elements is either mandatory or under active consideration in that direction. The rising profile of ESG is also very evident in the ESG investing trends. The shift has been driven by a range of factors, and I don't need to go into those details. One factor is, of course, that the investors are very keen to evaluate the financial implications of climate risks and other ESG-related risks into their decision making. And that's where I believe the regulators are coming into picture, and so their interface with ESG is threefold, as we see. One is ESG disclosures, second is ESG investing, and third is ESG ratings. Let me very quickly, since we are here in India, give you a quick recap of our interventions in this area, SEBI's interventions in this area. SEBI started on this journey way back in 2012 with a very elementary sort of a business responsibility report requirement, and we started with top 100 companies. Let me fast forward in the interest of time. Now we have a very thorough, comprehensive reporting requirement. It is called BRSR, Business Responsibility and Sustainability Report, for top 1,000 companies, which has become mandatory from this year. And recently, we have come out with a consultation paper where we are, consulting on a roadmap for assurance. We are also consulting on certain elements relating to ESG rating, and also we are, consulting on expanding the scope of disclosures to the supply chain going forward. So in this, that is, just a brief context and the background for this panel discussion today. We are very fortunate to have a very distinguished panelists with us. We have very senior professionals with us who bring in very rich and distinct perspective on the table. So let me now turn to the panelists without further ado. I have 3 rounds of questions, and the first round, and also, if the time permits, we'll have a 4th round, which would be a rapid fire round. That is just for fun's sake. So we'll see if we get there. But the first round has high-level questions for each panelist according to their areas of expertise. So let me start with Sue. So Sue, the ESG world is actually looking at ISSB very keenly, if I can say that. And we are aware that you are close to finalize the disclosure standards relating to sustainability and climate. And I'm told that you've received over 1,400 comments in your consultation paper, in the consultation process. So if I can ask you from a very narrow, somewhat selfish, if I can say, emerging markets perspective, because I am coming from an emerging market. So can you elaborate the key considerations such as proportionality and flexibility that ISSB plans to incorporate in the final standards from the emerging markets standpoint? Also, if I can add, what is the strategy for a just and fair transition and the timelines of implementation, particularly for emerging markets? Over to you, Sue.
Thank you very much, Amarjeet, and thank you very much for having me on the panel today. Really delighted to talk to you there in India. So you're right, a huge amount of interest and expectation around our standards, which we hope to publish by the end of June this year. And in the 1,400 comment letters that we got on our standards, I think the single most common message perhaps that we received beyond the support for the global baseline was that it was really important that the global baseline was a truly global baseline, so capable of being applied not just by the most sophisticated companies in the most developed markets, but also smaller companies and emerging markets as well. And so that's taken a lot of our time in our redeliberations trying to get that right. And I think one of the key things that we've built into our standard is really the ability for a company to approach the disclosures in a way that is appropriate given their resourcing, their skills, and what's available to them. And so one of the key things that we use throughout the standard where there's potential measurement challenges is this idea that companies have to use a reasonable basis for what they're doing, but that they should use information that's available without undue cost and effort. And the idea there is what would be expected in terms of inputs would be more demanding if you've got more resource and less demanding if you have more challenges in obtaining information. And so it's designed to be naturally scalable. So that means, for example, when you come to measuring something like Scope 3 greenhouse gas emissions, which we know is not easy to do, that we make it very clear that estimation is something that is totally appropriate to use. We don't expect you to go and get direct measurement from everybody in your supply chain, and so that it would be appropriate, for example, to use industry estimates and averages to calculate the numbers. And so it's those sorts of measures right throughout the documents that are really designed to make sure that we ask for similar disclosures from everybody in most circumstances, but the way that you approach it would be slightly different depending on your circumstances, and that's really important. And in some cases, if you are a company with less resource and sophistication or skills, then you are able to do more qualitative information provision rather than quantitative. So I think those are the two key things. In terms of what we're doing about a just and a fair transition, I think the key here is scalability, so making sure that it's an accessible set of standards for all. We're not judging what's good or bad behaviour from a sustainability perspective. We're very much focusing on transparency of information. And what we really hope will happen as a result of this is that investors will be confident to give money in emerging markets where funding is needed to fund transition. So we hope that emerging markets will be beneficiaries of our work. Now, in terms of timeline, we made an important decision at our February meeting about when we think the standards should start to be applied, and we were quite ambitious because we're quite proportionate in the way that people can start to use the standards. We're asking that companies start from 2024, reporting on their 2024 performance in 2025. But the date that will be relevant for companies will, in practice, depend on what jurisdictions decide. And so the decisions made by jurisdictions, and we'll be encouraging jurisdictions to think carefully about the appropriate timelines, and the appropriate timelines for large companies versus small companies will depend in large part on jurisdictional decisions. But we just really wanted to signal that from 2024 for 25 reporting, we really encourage people to get going, because we think the way to really get better at sustainability reporting is to get started. And that's what we really want to encourage.
Okay. So my next question is for Sacha. So I believe UK FCA has been working in the areas of sustainability disclosures, ESG investment funds and products, and ESG rating providers, all the three areas which most of us are engaged in. So can you give a brief overview of the overall strategy of the UK FCA on all these dimensions, please?
Good afternoon, everyone. One of the things that's very important is that we are the regulator for consumers of financial services. And therefore, we've got to make sure that the people who are buying the products, understanding the information, get what they need, get protection, and have competition, because we want good competitive places for people to buy products. And as you quite rightly said at the beginning, everyone is talking ESG now, whether it's on reporting, whether it's on products, whether it's on ratings. This has become a very mainstream area, and I've been very interested to see the things that you've been doing. So on that, we're making sure that we're using all of the tools in the investment chain. So we're not just focusing on asset managers and the products that they're selling. If they use the word green, sustainable, or ESG, we're going to say, prove that it has some credentials in this area. Two, we're going to talk later, but we are looking at ESG ratings, which I know SEBI is looking at as well, because it's important that the people who are rating these companies are looking for that. And then thirdly, we're also looking at ISSB and helping these standards, because we want one set of standards globally. And as Sue has said, we understand that it's early days. So we, in many things, whether it's TCFD reporting or anything else, we sometimes say, we'll start with the largest companies. We won't ask them to assure in the first year. And then afterwards, we start asking for assurance and we move down the chain. But we give people time and some reassurance from the regulator that it's worth trying this and pushing for this, rather than being very rigid and strict at the beginning. So I think that's some of the big important things. Thirdly, we are a regulator with many people who regulate in lots of ways, supervising, enforcing, and guiding. We're trying to train our own financial services staff to understand, because if we were to sit and have a cup of tea somewhere, ESG would be different for some people, for other people. So we have to do a lot of training to make sure people understand what we mean by this. And the same comes to the place, I'm sure you get this here, when people say net zero, someone's net zero is very different to somebody else's net zero. So we've got to make sure that we start giving guidance and helping make sure that people understand what we mean, and then they start doing it. So that's what the FCA is doing. But it's all down, the government has given us, and this is very useful for us, the government has said, we want you to help the UK get to net zero, and we want you to make finance positive to help sustainable finance grow. And so that gives us our sort of mission.
Yeah, thank you. So if I may turn to Navneet now. So, so Navneet, if I may, we saw a number of ESG mutual fund scheme. I'm talking about domestic context in India. So we saw a range of schemes launched in the last 2-3 years, especially in the COVID times. But lately, we've not seen any significant movement there. So what do you think are the major hindrances for adoption of ESG investing in India? And where do you think India is in its journey towards mainstreaming of sustainable investing?
Sure. Great pleasure to be here, sir. So the first fund got launched in 2018, and after that we saw around 7 or 8 more funds getting launched in the next 2 years. But in last 2 years, in this financial year so far, ESG funds would have lost around 1,000 odd crores of funds, and last year would have lost around 400 crores. So incremental flows into the funds have not been there. And this, to put in right context, these are the 2 years where mutual fund industry has seen huge inflows into the equity funds, but not into the ESG category of funds. Variety of reasons. One, that in India, and then all of these funds are based on exclusionary philosophy. In India, the evolution of ESG funds is very different than the rest of the world. In other parts of the world, it was the asset owners who put pressure on asset managers to adopt ESG or integrate ESG into their investment framework, or there was a pool of money which was available for asset managers to target. In India, it was the other way around. There was no pool of money available. Institutional money into equities is very limited. I mean, the EPF or the pension fund invest in broad market indices. Apart from that, it's largely money from individual investors. And there was no dedicated pool of funds that one was looking at. I think it was a conviction of some of these asset managers that over a period of time, this category would become big, and it's important to launch these products. But we haven't really seen a large interest from the investors. Also, as I said, that all of these funds were launched based on exclusionary philosophy, which is excluding certain set of sectors and excluding companies which have a lower rating on ESG by an external rating agency, and maybe higher controversy score. And what has happened in last 2 years, which is also the case globally, that some of the sectors that got excluded because of the controversy or because of the rating of those companies, those sectors have actually done pretty well. So tech and consumer, which were like high-rated sectors, versus materials and industrials, which were lower-rated sectors, which were underweight in these funds. So last 1.5 to 2 years, the performance wouldn't be as good as most of the other diversified equity fund. So purely based on performance, if an investor was looking at, they didn't get excited about the concept. But what ESG funds have done, as I said, that in India, it wasn't the pressure from the policymakers or a nudge from the investors, asset owners, where the asset managers adopted ESG. It was their value system, it was their belief, and then on their own, they launched the products. And I think the bigger gain from this is creating awareness about the ESG among masses, among investors, among various other stakeholders. I think on the G aspect, India has done pretty well. India would have been one of those few countries where asset managers in India, AMCs, thanks to SEBI's nudge, moved towards 100% voting on, voting on 100% of the resolutions way back when a lot of other countries are yet to move in that direction. Putting all our votes in public domain immediately after the quarter end, along with the rationale behind why we have voted in a certain manner. So on G aspect, I think we have done a lot. On the ENS, variety of other things are happening. SEBI also came up with the stewardship code in 2019, which has got completely implemented by the domestic asset managers in 2020. Over a period of time, as the reporting requirements are increasing and the awareness is increasing, asset managers are engaging proactively with their investing companies. Awareness about ESG is increasing. And now after the new consultation paper, where SEBI has also come out with not only one kind of ESG product historically, because SEBI has classified equity funds into different categories, and ESG funds were part of what is called a sector and thematic fund, and a fund house could launch one fund, and that particular time, as I said, exclusion funds were in vogue. But now the consultation paper has suggested that there could be different kinds of ESG fund. There could be a best-in-class fund where you are actually looking at companies without excluding any particular sector. You are looking at best-in-class in each and every sector. There could be impact fund. There could be thematic funds on ESG. There could be fund getting launched based on ESG integration, so on and so forth. I think once this is there, I'm sure ESG is evolving globally, as both the other panelists also mentioned. I'm sure it will evolve in the right manner. SEBI has been very particular about ensuring that funds don't do greenwashing, funds don't do purpose washing, and we develop ESG funds in the right manner. If you are labeling a fund as ESG fund, it must be true to the label, and we have to explain and we have to ensure that there are right set of prudential norms that the fund managers are following. If they are calling their fund as ESG fund, there have been a lot of mishaps globally, and I think learning from those episodes, I think SEBI is moving in the right direction to ensure that if you are calling it an ESG, if you are labeling it as an ESG fund, you are managing it very differently than all the other funds that you are managing.
Yeah, absolutely. So the fund, if it's called a ESG fund, it has to be true to its label. So that's a must. So I'm not asking any follow-ups in the interest of time. So let me move to the corporate sector representative, and that too from an energy company. So I believe you are at the receiving end, if I can say, because whatever we do is directly impacting you in terms of adopting the regulatory frameworks and so on. So can you give us a peep into your boardroom, how the ESG strategy discussions are happening, how you are adopting the new trends, the new requirements which are, brought in by regulators?
Good afternoon to all of you. Amarjeet, like what you are telling, we are at receiving end of this entire exercise of ESG, but we don't feel that way, right? As a company, we feel that we have got a responsibility towards all our stakeholders. We have a responsibility towards environment, towards our social obligations and governance issues. This has been the theme of NTPC's corporate history since the beginning. Particularly, if you look back, our reporting, we have been reporting on sustainability for the last 10 years or so. We have started this journey in 11 and 12. So our entire top management is focused towards ESG issues because it is directly affecting our business. Our business is mainly till now is focused on fossil fuel energy generation. And we are now in a transition. We are moving towards renewables, towards technologies which are less carbon intensive, and we have got certain goals also set for this. If you remember, some of you might be aware, NTPC has entered into a memorandum of understanding with NITI Aayog for charting out our net zero targets and how we are going to achieve that net zero over a period of time and what will be our deadline for net zero. This kind of strategy formulation and planning is going on in right earnest and all seriousness.
Sorry to interrupt you, but can you share if your board has sort of set a corporate net zero target, what is the timeline around it? Unless it is confidential, you don't have to.
Yeah, actually I was about to tell that because this exercise is being done in association with NITI Aayog, which is Apex policy making body in this country. And also our net zero goals will be in tune or in sync with our national goals. Like Prime Minister has told, our net zero for this country is 2070. So definitely NTPC will be in sync with that goal, and we are working out strategies how we can achieve this net zero even before that. So this strategy formulation and planning, how we are going to reach that goal and what will be our intermediate goal, let us say by 2030, where we will be, 2037, where we will be. These intermediate goals are also being set. And as I was telling, our board is entirely focused on these ESG issues because this entire climate change issues are going to affect all the companies in the world. And the companies which are producing greenhouse gases, which are emitting greenhouse gases, they are at receiving end and they have to make a strategy, they have to have a strategy how they are going to mitigate this risk. So entire board is focused on this, particularly our director operations is in charge for ESG issues. and he regularly monitors. We have got because ours is a very widely dispersed country with the business units spread across the country. We have got regions, and he reviews regional performances every quarter. So during these regional performance reviews, ESG issues and ESG risks are one of the few focus points on which discussions take place. And we have got a board level committees for CSR and sustainable development where ESG issues are discussed. We have got a risk management committee at board level where again the risks associated with ESG issues, these three pillars, environment, social and governance, they are also discussed, and they are monitoring how we are progressing on the goals which are set for these ESG issues.
Right. That's encouraging to know. So if I can now turn to the second round of questions to our panelists. So the second round I intend focusing on the way forward and maybe capacity building issues. So if I can go to Sue again. I believe, developing the standards which, as I said, the whole world is looking forward to. So that is a critical first step in ISSB's journey, and I think that is the first major milestone for you. But can you give us a sense of the road ahead? If you are looking at, the road beyond prescribing the standards, and how is, more importantly, the focus has been, to my mind, so far more on coming out with a prescription rather than how will these standards be implemented. So does ISSB have any strategy around assisting the implementation process?
Back to your question, if that's okay. So you asked me about what's next once we get the standards done. When we finish the standards in June this year, the next thing we need to focus on is getting countries and companies to apply the standards, and then really importantly helping people in the application as well. So we know that with sustainability reporting, we've got a really important role to play, and we feel a sense of responsibility and want to help the market. And what's really important about this is I think there's a particular need for capacity building in the global south, emerging markets, but it's also the case that in developed economies as well, many are starting the sustainability journey. So I think there's a broad need for help in this space, and it's something we're already starting to plan for. So the first thing we'll be doing is when we issue the standards, we'll make sure there's examples included in the standards and materials that we refer to help people to get started. But then what's really important in our structure is that I'm actually not the only vice chair at the ISSB. There's a counterpart for me, another vice chair, Jingdong Hua, who's based in Montreal. He joined us from the World Bank, and he has been appointed with a particular focus on capacity building, especially in the global south. And so we're putting a lot of energy into that. And at COP27, we actually announced the formation of a partnership platform, which is an arrangement that we're putting in place with, I think, more than 30 now private and public sector bodies, including the large audit firms, but also World Bank and others, to work in the market to really help people on the journey on sustainability reporting. So we will be working to help preparers to understand how to undertake sustainability reporting, audit firms to assist in the assurance, regulators. Sacha mentioned that even regulators need help, so we'll be involved in that space. And even investors. We want to make sure that investors who are getting this new type of information understand how to use it, and that you need to be really careful with the nature of the information and the assumptions. And so we've got a really big initiative coming up where we really want to work in the market to really help get everybody on board to get this new type of reporting off to a good start.
Right. So Sacha, if you could tell us about, the regulatory capacity building piece. Yeah.
Look, and it's really fascinating that we're doing things, although we've seemed to be going a little bit faster, we're doing things in very similar ways. So, Mr. Munot, I know you've got the ESG advisory committee in SEBI, and we have done exactly the same in our area, where we're trying to use the industry, and so that we've got the industry talking to the regulator, because this is very important that we get this right, because one, it's growing fast, And we have many consumers that want these products, so that might be slightly different, as you were saying. But secondly, that we make sure that we're not too strict too early, but we also make sure that we understand. So we have an advisory group of investors and industry players, including CFOs and CEOs, to talk about what's going on so that we can learn and test. Secondly, we use consumer testing. We test these labels with consumers to make sure that it is fit for what they want. And I think that's something that's very important, that we always think that we understand what people want, but you only understand that when you actually go out and test it. And we learned that people don't understand stewardship or transition. They don't understand those words. They like things, but they like words like improve. They want to invest in a company that is trying. So I think that's very important that we use those kinds of words in testing. And then, of course, IOSCO is the International Securities Regulator, which you are, SEBI is very, very, very big in. I'm the vice chair of the Sustainable Task Force, and I'm making sure that we bring other regulators together and not go off and do something that might look beautiful, but it's very niche. We've got to make sure it's relevant to our market, but it's consistent with what others are doing. Because most of the companies that invest, most of the asset managers, they're global, they're international, and therefore we can't be too prescriptive. And so working very closely with Sue is very important to make sure that we have one set of standards. And then lastly, and very importantly, training. We do, when we put a rule out, we have webinars. We try to give explanations. When the first round of reporting on TCFD climate disclosure, we wrote a report saying what went well, what didn't go well, what you should do for the next year, but without being too prescriptive, because we want the market to raise the bar, but slowly. And as I said once before, take your time on smaller companies. Give them a bit longer than you would give large international companies that are listed in the UK. So hopefully that helps.
Right, thank you. So if I can turn to you, Navneet, at this point, and this would be on the way forward. So the ESG risks and opportunities may not necessarily be specific to schemes labeled as ESG, and they could affect the performance of non-ESG schemes as well. So what are your views on whether all mutual fund schemes, irrespective of ESG label, should integrate ESG considerations in their investment decisions?
Yeah, absolutely. So the success of ESG should not be measured in terms of how much money is managed in funds which are labeled as ESG fund, but how it has been integrated into the investment process of all the mutual funds who are managing the public money. And over a period of time, I think that's a lot more important than just seeing that number of ESG labeled fund kind of going up. Over the years, as I mentioned, that with the stewardship code coming in, the engagement of investors like us, institutional investors like us with the investee company has gone up very substantially. And earlier, as I said, it was more on the G aspect, but now increasingly more on the E and S aspect as well. Pandemic has really highlighted the importance of S, and of course, E, we don't have to talk much. You don't have to read the IPCC report. You can see around you wherever you are in the world. Climate change is for real. For example, we are a large shareholder of NTPC. I can say it because it's in public domain. And over the last couple of years, we have regularly been engaging at various levels on these issues. And I think that's a lot more important, as I said, that integrating ESG into the entire investment process. It has to be part of your belief system that integrating ESG leads to better risk management, leads to alpha generation, leads to better, I would say, sustainability of your returns over a longer period. And it doesn't come, there is no trade-off between sacrificing returns and generating better returns over a longer period. If that belief system is there, then I'm sure over a period of time, all the mutual funds can integrate more and more. If you look at India, more and more institutional investors are signing UNPRI, UN Principles of Responsible Investing, and committing themselves to integrate ESG into their investment process to better quality disclosures to them, so on and so forth. More and more fund houses are looking at similar initiatives. In my previous role, I used to be on the Asia Advisory Committee of Climate Action 100 plus, and we were engaging very deeply with all the companies which are part of those 160 large carbon emitters globally. And I think almost more and more fund houses increasingly are looking at ESG proactively, trying to integrate the non-financial information, looking at the environmental footprint or the social impact or the the governance into the mainstream investment process. And to me, I mean, that's the future or way forward for ESG. So one, of course, everybody knows the definition of ESG: environment, social and governance. Another definition that institutional investors should look at ESG as engagement, stewardship. And if you do these two right, you're basically helping the companies in their journey of going from good to great. So to me, that's the real ESG for institutional investors in the long run.
So I guess what you're saying is that at some point, every investing will become sustainable investing in some sense.
Exactly.
Right? And you don't really need special ESG schemes.
See, the large institutional investors like us don't have the luxury of voting with our feet. If you don't like something over a period of time, if you're managing passive funds, it's part of index, you have to own it. And that's why the responsibility on our shoulder is to engage constructively, engage proactively, because that option is not there beyond a certain size.
Yeah. So in the similar context, I personally feel at some point all these green bonds, yellow bonds, blue bonds, I think these colors may lose
so always say in any of these kind of events, particularly because you talked about the green investing, that our bigger goal, particularly where we are in India and where we have to look at our SDGs in 2030, etc., it should not be about how do we finance the green. It should be about how do we green the finance. It's about moving from financing the green to greening the finance. That has to be a larger objective.
Yeah, and then the instrument loses its color, right?
Absolutely.
So,
absolutely.
Yeah, so that's interesting. So, Mr. Reddy, I know you've been very active in this space, and as a large company, you've got tremendous experience. So what would be your advice to smaller companies in especially adopting the disclosure frameworks?
NTPC has been reporting and giving these disclosures for the last 10 years. So we have got a fairly long period of experience in reporting. We started with GRI reporting, then went on to BRR. Then last 4 years we have been reporting in IR and the integrated annual report. So this kind of experience has been gathered over a period of 10 years. So we are now ready. Like last year itself, we started reporting in BRSR formats, all our disclosures. But as you rightly said, BRSR, it has got a more breadth and depth. Reporting is more precise, more clarity is required in numbers, and it encompasses most of our operational areas. Not only GHG emissions, environmental, many other emissions and factors are taken into consideration, like water usage and intensity of the usage of these precious resources. Similarly, the issues related with social and governance pillars also have to be reported in a very elaborate and precise manner. So this requires, for a big company like us, which is spread over, which has got so many business units, it requires a lot of coordination, collection of data, and the teams have to work in sync with each other. So what is required, reporting under BRSR, our local unit should know what kind of data is required that has to be given to us. So this exercise we have started almost 1 year before, where we have formed teams. How this data will be measured, collected, and reported to the corporate center, whereby this entire data will be compiled. So formation of these teams and capacity building of these teams, giving them training, and guiding them how they have to proceed in this manner, and the formation of a cross-functional team between different functions, because it involves a lot of cross-functional activity in reporting this data. And one more thing which we found out very useful is we have got a SAP ERP system with us. So a lot of data gets reported to many of our regulators. Like CPCB, for all environmental data, we report to CPCB. So that data is already there with us. for reporting under BRSR.
Any quick tips for smaller companies?
Yeah.
I know you are a big company, you have a lot of resources, I'm sure. So,
For smaller companies, one or two things which they can do is formation of these teams, whereby focusing on the attributes where they need to report the data that has to be collected, and teams have to be, trained in collecting and reporting that data. Second thing is digitization of all these activities. That is going to greatly help in reporting. If we have a digitization of all our processes, then collection, measurement, collection and reporting will be very easy. This is what we found out. And anyhow, the smaller companies, they have to report on essential attributes. And they're all, what we found is in BRSR, they are all very precise. Clarity is there, what is to be reported. I don't think there will be much a problem in reporting on these disclosures.
okay, that's helpful. So let me now move to the third round of questions, and the third round is on the, if I can say, a counter narrative or a counter movement which is building up in certain parts of the world, especially. So, and this is a question for Navneet. So lately, as I said, particularly in the wake of war in Ukraine, the discourse seems to be, changing, or a counter narrative or a counter movement, if you call it. It seems to be building up against the mainstreaming of ESG. It is, contended by some groups that attention will shift more to the elements of Maslow type of hierarchy of needs, and the movement to net zero may be temporarily jeopardized. So, and there is some evidence, it is not just an empty talk. So there are moves seeking to prohibit financial institutions from following the ESG guidelines. For example, in the US, what I read recently is that some states have already passed the laws prohibiting pension funds and other institutional investors from investing in ESG areas. And we are also seeing skeptics who feel that ESG is a fad, it's enriching consultants, it is, just not a long-term thing, and it is doing nothing for the businesses and investors. So that's the counter narrative. I don't personally, let me say, I believe in it. But I thought I should bring it on the table. So what is your take on this counter narrative, Navneet? And also, do you think ESG investing can make the world a better place?
So despite being a very strong proponent of ESG, particularly in investing, I'm very happy to see this debate over the last couple of months, because this was really required. ESG is a highly nuanced subject. You can add more. Over the last 100 years, we have the accounting standards globally as well as in India. It's pure, these are numerical numbers. But still, every 2 or 3 years, you have a new debate on, let's say, lease accounting or variety of things. On various things, options accounting, so on and so forth. Now in ESG, you are dealing with very different set of factors, and a lot of them are actually qualitative in aspect, whether on E and S and even on the G side. Over the last couple of years, because there was so much of interest in ESG, and as I said, that asset owners were looking at asset managers who have those kind of funds, people just launched funds and got a lot of money. That led to a lot of greenwashing and purpose washing among the corporates, among asset owners, among asset managers, and probably everywhere. I think this debate was needed to ensure that ESG moves in the right direction. The evolution happens in the right manner. Kudos to SEBI again. I think with that committee and the report and the consultation paper that is out in public, how do we have the best quality and the reliable and trustworthy corporate disclosures? How do we have where the analytics can be done in the right manner, in the format it should come? Similarly, on how the rating should evolve over a period of time. Can you have just one size fits all and just put in a box how the company should be rated? Or you look at various different scenarios, and similarly on the investing side, how it should evolve over a period of time. I'm a very strong belief that for institutional investor, what is important? I'm a perpetual investor. Money will keep coming in. India is $3 trillion. Our industry is $500 billion mutual fund industry. India will become 5, 7, 10, 15, $20 trillion. The assets that we will have as an industry will move from $500 billion to 1 to 2 to 3 or 4. What is good for us? That businesses have the societal license to operate. That businesses don't damage environment so that they are not borrowing from the future. If the sustainability of business is going up, the durability of their earnings go up, and society is happy seeing them making more money, it's good for the economy, it's good for capital market, and it's good for asset managers. As asset managers, if we only focus on the alpha that we are generating, that too in the short term, I think if we focus on the time tension, a lot of challenges can get addressed. But I extend that horizon and see in the longer run. I mean, as J.R.D. Tata mentioned, I think several decades back, that the businesses earn their license to operate from the society and their responsibilities towards them. If businesses don't do that, neglect the environmental footprint of their business, if they take the society for granted or shortchange any of their stakeholder, if governance is not of the highest standard, do you think in the long run it's good for the institutional investors like us? It cannot be. It cannot be. That's why I'm a strong votary of this debate. This will actually lead to a very healthy development of ESG the way it should be. I strongly believe, I mean, whatever is good for society is good for my portfolio, because ultimately sustainable returns can only come from that. Otherwise, it will manifest. I mean, if there is a societal anger, it will manifest in some manner which may not be good for us in the long run. So I think integrating ESG from that perspective, where it becomes part of your value system, is part of your belief system, it's part of your risk management, and you think that in the long run, it's good for our investors as well as for us. And of course, if it is good for our investing company, it will be good for us. That belief is there. I think we'll move in the right direction. And if you look at the world, if I can take 2 more minutes, so look at the world today, and you say that I will ignore ESG, you can ignore at your own peril. I mean, you don't have to read IPCC report, as I said. Climate change is for real. I mean, you can see the erratic weather events. I mean, the sea levels are rising, oceans are acidifying, polar caps are melting. I mean, billion animals died in bushfires in Australia to California. I mean, you can go on and on. Soil is degrading, forests are shrinking, biodiversity is getting damaged. You can go on and on. You look at the newer generation as consumer, when they are buying stuff or services, they are looking at the impact on the planet and the society. They are willing to pay a little more. When they are investing, they are not only looking at the return, they are looking at what it is doing to the planet and my future. When they are working, when they want to work as an employee, they are looking at the deep sense of purpose or the meaning of their work in the organization they work for. We are in this world. Data is the amount of quality of data or information is increasing. And if, let's say, if our government and policy makers are going and pledging, whether in Glasgow or Sharm el Sheikh or anywhere, can businesses ignore that? Can, as an investor, we ignore all of these trends? Not at all, at our own peril. So I'm a strong believer in ESG, but I'm very happy to see the debate that has started happening, particularly in last few months. And I think this will only be very healthy and will nudge us in the right direction.
So if I can quickly add, and I'm tempted to do that, if you want to counter this counter narrative, so you probably need to build more evidence that financial returns from investing in ESG kind of schemes or ESG investment in the long run tend to be as good as investing in non-ESG schemes. That is A. B, if we can, also build some sort of, tempo around the significance of social returns, which are non-financial. But mind you, these social returns, if they become measurable, then, there is an evidence that there is a benefit of both financial and non-financial returns when you take a ESG call. So let me move on. The next question I have for Sue, this is on, this is not strictly on the counter narrative, so I don't want to alarm you there. But this is more on, the 2 contentious issues which have been coming up, especially from this part of the world, is that the proposed disclosures have climate-related scenario analysis and also require quantification of anticipated financial implications. So there are concerns. For example, in India, we don't allow financial projections at the time of IPOs. So there are concerns around ability of companies to make forward-looking quantitative disclosures with fair accuracy along with potential liability concerns. So how is ISSB proposing to deal with these issues? And what form and guidance can we expect on these fronts?
Thank you. Can you hear me?
Yes.
Brilliant. So firstly, Navneet, I'd like to wish I'd recorded you so I could use you in some of my outreach. That was a very good articulation of the importance of the information for investors. But on the specific question, so on the scenario analysis and the quantification of anticipated financial implications, I think the first thing to say is not everybody's going to have to do that on a quantitative basis. So that's really important to point out, first of all. And even those who do it on a quantitative basis, it's on the basis of what information is available without undue cost and effort that's reasonable and supportable. So it's not asking people to do the impossible, I think, is the first thing that I would point out. What that means is that companies, if they need to, in both cases with scenario analysis and quantification, we have a special part of the requirements, which is to say that if you're an entity that, based on your skills, resources, and experience, aren't able to quantify in these circumstances, you can do a more qualitative type of assessment. And I think that's a really important change that we've introduced in the final document that was different to the exposure drafts. But what is important here is, I think, sort of building on what Navneet was saying, that investors want to understand and be comforted in a way that the management of a company is thinking about what the business will look like in different scenarios. Are you thinking about what you're going to have to do to adjust your business because of the physical risks from climate change? Are you thinking about how you're going to have to adjust your business because of the transition risks if you're going to be required by regulation, etc., to have a 1.5 degree compliant business? How is that going to look in the future? And even if you can only do that on a qualitative basis, explaining the processes you've been through and what your assessment is of what your business would look like in different scenarios, that's really useful information. And at its heart, that's a lot of what we're looking at here. It doesn't necessarily have to be quantitative. On the other hand, if you've got a lot of climate exposure and you are a well-resourced, sophisticated company, and you do have a reasonable basis for doing this, we do want to encourage more quantitative information, because that's helpful for investors. Investors are going to know that this is not perfect. They're going to know that these are estimates. They're going to know that there's a lot of assumptions, and we're going to require all of that to be disclosed. But we think that's really helpful for investors to get their understanding of how the company's thinking about things, to think about whether or not they think the basis of the analysis is one they can get behind and have confidence in. And that's really important for confidence of investors in a company as well. It's also an opportunity to attract capital. If you're thoughtful, thinking through transition risk, and you've got a good plan, that's a positive when you're talking to investors. So it's an opportunity as well. But going back to the practicalities, what guidance are we providing? So in the documents that we publish, we will have examples of the types of quantitative information that may be appropriate. That can be as simple as saying, how have you adjusted the useful life of your assets for depreciation because you've got a plan to change the way your factory is run? That's quantification of a type. And we'll have these sorts of examples in the document. And we'll also point to some third-party materials. So for scenario analysis, we know a lot of people aren't sure what that means or how to approach it. So we will make a reference to the TCFD guidance on scenario analysis, which explains you can start with qualitative analysis, and then there's more sophisticated versions all the way to sophisticated quantitative analysis, and we get people on the journey. And so those third-party materials, we hope, will build understanding, and we'll really be encouraging in our requirements that people get better over time, but they get started with something simpler. And so we're trying to help people again on this journey.
Great. Thanks for that. Mr. Reddy, if I can ask you a question on the renewables. So fossil fuels are amongst the largest contributors, as we all know, to GHGs, the greenhouse gas emissions. It is widely accepted that substantial investments in our context, are required to be made in renewable energy sources to achieve the targets which are given under the Paris Agreement. So in a high growth economy like ours, can renewable sources of energy replace fossil fuels? And what are the possible trade-offs on costs and scalability?
Right. Like what our Prime Minister has told in Glasgow, that we have got a net zero target by 2070, and in the same our NDCs which were given, it was stated that we will have a 50% capacity of entire power production by 2030. So these are the goals which are set. So that roughly translates to about 500 gigawatt of renewable energy capacity by 2030 for the entire country. Similarly, NTPC has a plan for renewables of 60 gigawatt by 2032. So these are the kind of scale up of renewable capacity in the entire grid. But at the same time, we should remember the renewables, particularly the solar and wind, are intermittent and seasonal, and they require a balancing power during the time when these solar and wind are not available. So if we look forward to, let us say, next 2 decades or 3 decades, then the balancing power should come from some source. The existing power generating capacity is in fossils. So high efficiency fossils which are near to pit heads, still they will be running because they have to fulfill this role of energy security. They have to provide energy during night time when solar is not there, till at least we get viable grid scale storage systems. So we expect that fossil fuel coal-fired power plants will be there for some more time. It is a fact of the day now. But renewable capacity will be going on adding into the grid. But at the same time, it will throw up a new challenge in the form of how we are going to harness this renewable power for our balancing power requirements. So it will require a lot of storage capacities, either in pumped storage, which will be a grid scale, or battery. BESS is slowly picking up, but a grid scale BESS has not yet come. Then you will be required, here the thing which is going to fill the gap will be hydrogen. Hydrogen is a thing which is very high dense energy storage system. When renewables are there during daytime, that power can be used to produce hydrogen and stored for producing power during night time, or for using this hydrogen in other industries, like when you want to decarbonize, let us say steel making, or cement industry, or chemicals and fertilizers. These are the areas where hydrogen can find much of its use. So this is one pathway which is going to happen in future now. In next 5 years, like everybody must be aware now, Government of India has now instituted this green hydrogen mission. So where a lot of investments are going to come in there, approximately 20,000 crores. And there is a target of producing 5 million tons of hydrogen by 2030. That much of capacity will be created. So this is one pathway which is going to be there in near future, that hydrogen economy, hydrogen ecosystem will start developing. Then parallelly, these traditional power generating systems will continue for a few more decades. And in between, small modular nuclear plants. Again, this is one area where every country is looking at to fill this balancing power requirements. So they may also play a very vital role in providing this balancing power in future.
So if I understand you correctly, I think over time the conventional sources will fade away with more technological advancements and more greater adoption of renewables, right? In short, right?
Yes, but this transition will be, it may take different pathways, and the kind of investments which you are talking about, it will require a lot of investments in these new technologies. Like a study states that India requires about $10 trillion US towards our net zero transition. Out of this, about 8.4 trillion will be for energy systems. So this is the kind of investments which will be required during this transition phase.
I just hope, some good technological innovation comes our way, and, that may be the game changer, but we will see. So that brings me to the end of the third round, and I guess if we have few more minutes, we could just jump into the fourth round, which would be just quick questions. As I said, sort of rapid fire, and you may choose not to answer. I do understand. If you think it's sensitive, you just say pass. You don't want to answer. That's fine. So I have I think a gentle nod from organizers for taking few more minutes. So I'll straight away jump into that. So this is addressed to all the panelists. E, S or G. Which should come first for a company? Navneet, we'll start with you.
No, of course, I think if it's a right G, then focus on E and S would also be there. I think without G, without the...
It has to be a short answer.
No, I think a G, because the E and S follows from that. If you don't have the right governance and board buy-in, then E and S won't be there.
Your answer is G. Mr. Reddy.
Yeah, I think it is G.
So,
Well, I'm not meant to tell companies what to do, so I'm going to focus on what needs to be first for reporting, and I think it has to be climate because it's so material for investors from a valuation perspective. So I'll cheat and say that.
okay.
I'll go G for the reasons I've been an investor for many, many years. If you don't get the right people at the top, they won't do the right thing. And how are they going to look after their employees if they're not looking at these measures? So E and S are fantastic, but G is always the starting point, and that's always the case.
Right. So the next question, this is for Sue. Can you comment in one line, what is the most common misunderstanding of ESG?
That it's just a moral issue.
Do you want to elaborate that a bit?
Well, it's about, for me, and what we're focusing on, it's about risk management and informed investment decisions. It's not a moral issue. So it's exactly what Navneet was saying before.
Okay. So
And
next question.
I would say as well, the one that we get is ethical. It's not ethics. Everyone has different ethics. People might want to not have tobacco or gambling. It's not that. This is just business. And as we've said before, a good business thinks about its training or employees or paying its suppliers or health and safety. It's just part of doing business, not green.
Navneet, according to you, what is the most common?
The Milton Friedman is it Friedman who got quoted that the only responsibility of business is towards shareholders. But maybe I think if he was alive today, he would have said the same thing in a different manner, that if they are not focusing enough on E and C, then what is the responsibility towards shareholder? I mean, they won't be able to fulfill their responsibility towards their shareholder.
Another quick question is was Milton Friedman right? Yes or no? Was Milton Friedman right?
No, maybe I think it's a context. Maybe if he were alive today, he would have said that if a management is not focusing on the E&S, they are not fulfilling their responsibility towards shareholders, which is their primary responsibility.
Okay, sure. So the next set of questions for Sacha, quick questions. ESG for small and medium companies, necessary or overkill?
No, they have to do this because it's part of business, but they do it their way. So absolutely necessary, because your employees are just as important. In fact, they're more important in a small company because you can't keep recruiting like big companies. So again, just make it real and keep it simple.
That's loud and clear. So carbon offsets, opportunity or obfuscation?
Massive opportunity if there's quality in the market. Back to what we've said before, we need assurance, and we're trying very hard with everyone to make sure that they're real. But it is important, it's needed.
Right. The last one for you. Are accountants best placed to undertake ESG assurance? Yes or no?
No.
Good to hear that.
Others need another skills needed.
With excuse to all the accountants sitting here. So.
Not on their own.
Okay, Navneet, turning to you. So 3 key performance indicators that can measure a company's ESG performance. You are an investor. So
Three
key performance indicators that can measure a company's ESG performance.
I think overall on the emissions on the E side, I think S would be, I think the overall DEI, I think one or two things will reflect what they believe in, and maybe NPS will reflect what S is all about. G, I think in India, though we have borrowed everything from Starbucks and Cadbury, but I think India, because of the minority shareholders and promoter and management being the same, I think it's about the quality and composition, efficiency and effectiveness of the board, which includes everything. We have this whole concept of core BRSR. So those 11 things, kind of 9 things, summarize everything.
Okay, the next one. Comment in one line. ESG investing as you see it 10 years from now. One line.
It will remain same for me. What is good for the society is good for your portfolio.
Okay, next one. ESG funds delivering alpha. Fact or fiction?
Rightly labeled, I think. If they are not doing greenwashing, they will deliver alpha. Yeah. I mean, if it's just a label, then it won't deliver alpha for sure. Because if the intent itself is not right, the result cannot be right. I mean, we in India believe in karma. I mean, if you are telling people that...
It has to be a short answer.
Yeah, so I said that if it is just a label, it may not. But if it's rightly managed ESG, it will deliver alpha for sure.
So I think yes, right? In the long run, that's what.
Yes.
In a sense, you're saying that alpha, yes, in the long run.
Yeah, absolutely.
Okay, turning to Mr. Reddy. Nuclear energy, although you mentioned that, an alternative to fossil fuels, yes or no?
Partly yes.
Yes?
Partly.
Partly yes. Okay, we'll discuss later why partly, but you don't have to answer that now. So, does driving the ESG agenda come at the cost of sacrificing financial performance? Yes or no?
No.
Okay. Biggest challenge associated with sustainability disclosures as per the ISSB standards?
Biggest challenge.
Challenges, yeah.
Actually, if we have international standards which gives baseline, and if they are adjusted to our jurisdictional areas, then it becomes very good for all.
It's manageable.
It is manageable.
Okay. The last question, Sue, I started with you and I'll end with you. So the last question of this round is, it's a little long question, but the answer would be short, I'm sure. So intensity ratios such as greenhouse gas emissions, intensity ratios that are calculated on the basis of revenue should be adjusted for purchasing power parity to enable global comparability and be fairer to low-cost developing economies. Agree, disagree?
Well, the easy answer is we're not going to opine on this because we're not requiring an intensity measure because we're concerned about global comparability. So that means that companies get to choose what they think is most relevant for their investors. So they get to answer your question.
Okay. Thank you for that. So I don't know if we have time for any questions or...
I think we finished.
We have overshot. So with that, thank you very much, especially, our guests from Europe, both Sacha and Sue. My apologies for the technical glitches today, but I think we had a wonderful conversation. Thank you very much for taking time out for this. Yes, please.
Thank you very much.
Yes.
Yes,
Thank you.
for asking me.
Thank you so much. Thank you. And thanks, Navneet, and thanks, Mr. Reddy. Thank you.
We will conclude the session. I thank you all the panelists and the moderator for sharing their important views and insights on the theme.